Good evening and welcome to Money Matters. My name is Pat Welde with Merrill Lynch. My co-host this evening is Patricia Dunn, also with Merrill Lynch. And our special guest tonight is Mark Mulholland from the Matthew 25 Fund. Glad you could join us, and hopefully you'll enjoy our conversation because we're going to talk about lots of things. Why don't we start with the volatility in the market? There's been a lot of gyrations in the market, some of it uncomfortable in the last 3 to 6 months. I think a lot of the easy money has been made.
Mm-hmm.
We are 5-6 years into a pretty good market, certainly domestically. The U.S. stock market's more than doubled from where it was, and that's leading many people to say, well, it's more than doubled, therefore it's expensive. So let me ask the two of you. I mean, do you think the U.S. stock market is expensive?
I'm leaning more towards fairly priced. I believe that investors and therefore stock prices are teetering on the edge of what's next.
Mm-hmm.
And there's quite a bit of fear out there as to when are these interest rates going to rise and what's the impact going to be. But I think if you take a longer term perspective and go out 10 years, I feel the market's got a lot higher to go in the next 10 years.
Mark, what are your thoughts?
Not far off from Pat. I think the market is, well, I can tell you, even though we're not supposed to date ourselves, we're right now at a 18.15 P ratio, which is above average.
Mm-hmm.
So we're up there. It's nothing like it was in 2000 where you found a lot of things overpriced.
Right.
So I would agree with Pat saying we're fair priced, probably above average fair price if you look at things, but not overpriced. It's not, I don't find many things that I think, oh, no way you can buy that.
Sure.
Mm-hmm.
So,
yeah.
And there are things to buy, which is really what I believe in.
Yeah, and that leads me really to my second thing that I want to discuss, and we will get back to some of what's causing some of the fears out there, like interest rates. We'll come back to that. But the last several years, it's been very easy to not do a lot of work and invest in indexes.
Mm-hmm.
The indexes have done very well, whereas, and the data will prove this out, that it's been rather challenging for a good, talented stock picker or an average mutual fund manager to outperform their benchmarks or the indexes. Certainly not your fund. Your fund has done incredibly well, and I ask anybody to take a look at it, the Matthew 25 Fund. But I really think that in front of our eyes is starting to change in a meaningful way. I think that talented stock pickers that do research, good old-fashioned kick the tires, are going to do a lot better than the market overall. Because that's what people always talk about. The market's expensive. The market's expensive. And in fact, I don't know that really too many people that own the market unless they own indexes.
Exactly,
So
the Vanguard funds.
Yeah.
What are your thoughts about stock picking versus passive index investing, going forward?
There's no question. It's in fact, if you're an indexer and you look at the market and it's 18.15 times earnings, you want to be careful. You want to run. Yeah. But on the other side, I always do I spend most of my time doing what I call search and research, looking at new stocks, partly to make sure what I have is good or try to find a new idea.
Mm-hmm.
And what we have, and I feel better about my portfolio right now relative to the market, and I don't think the market's terrible. It's nothing like 2000.
Right.
Than I did at the bottom of 09. In fact, I had a fairly good friend who's a client. He remembers. I told him he had called some point in 09, pretty close to the bottom, and he had a fair amount with us. And he said, "Is there anything else?" I said, "Buy an index fund. It's just all you had to do was be in American stocks."
Mm-hmm.
Right.
Now, you want to be a little more picky. It doesn't mean you're going to get burned.
Right.
You're going to do okay returns. I mean, at 17.5 long-term average, the market does 10% roughly. So you might do a little bit below that at the valuation right now. But there's companies in there that I would have bought back in 09. A couple of our stocks are selling at 7 times EBITDA, no leverage, great businesses. I mean, that's great.
Right.
Mm-hmm.
Pat, do you agree?
I absolutely agree. Our favorite strategies for growth are earnings driven, and we do a lot of analysis in that area. And I'm finding more stocks that are showing up that are meeting our parameters to be buys than I'm seeing falling off as sells.
Can I add to that, actually?
Yeah, sure.
Where we are in the market cycle, we're not in the overpricing stage. When we get overpriced, growth will get overpriced. and it's not overpriced right now. And I have another friend who runs a fund in California called the Berkshire Focus Fund, and he's a real high kind of momentum, high growth investor. And we talk almost every day, and I keep saying, I go, we're coming into your market. This is really where you want to be. You want to, and even now, I'm searching for growth, like as I do my search process. And you can find stuff. I went through a list of what was like a screen on growth, and not aggressive. I used 11% growth in cash flow over the next 5 years. And about 350 companies, about 8 appealed to me, and we already own 3 or 4 of them. So it's where you want to look and where you want to be.
Absolutely. It's a stock picker's market that we're entering.
Well, you had mentioned earlier, Pat, one of the concerns that's out there, and I would tell you, I really do. I feel badly for the do-it-yourself investor, because with the news as intense as it is nowadays, there's news coming from all over the place, not just the TV and the radio, the traditional places, but now you got people tweeting out things, and it's like never ending. And as you know, in our world, pessimism sells, so the negatives are going to be out there. But one of the things that's concerning a lot of people is the recent move in interest rates in our country.
Yes.
And I will remind our viewers something that Mark said earlier, that our program is taped. So obviously, make sure you're confirming anything we talk about, with your own professionals and your own advisors. But in the last, 60, 70 days, interest rates measured by let's say the 10-year Treasury, have moved up 0.5%. Which normally would not be a big deal if it was from 7 to 7.5. But when it's from 1.9 to almost 2.5, that's a 35% increase in rates.
Exactly.
Is that something that you're concerned about? And what do you think the impact on rising rates will be for the U.S. stock market?
I think initially, and I think we're seeing it already, it's going to lead to a decline in stocks, particularly dividend-paying stocks. We've been seeing that for the last several months because they have maintained a rate of cash flow through the dividends. It's roughly been equivalent to the 10-year Treasury bond. But now, with the rate on that bond going up, we're seeing the prices of these dividend stocks going down. And they've been underperforming relative to the market.
Right.
But as these rates continue to go up, I believe we're going to start to see more money come into these dividend-paying stocks because they're depressed. So I'm telling people this is a good move.
Use it as a buying opportunity.
Use it as a buying opportunity because when pain points are hit, that's when the public makes its move. And when people start realizing that they're losing money on their bonds, that money's going to move. And where's it going to go? Because the people who buy bonds need cash flow. They're most likely going to go into dividend-paying stocks, which will lift that ship.
Okay.
So,
Mark, I know that you're a stock picker, but I also know that you're a smart guy and you don't ignore other things like interest rates. So what are your thoughts on movements in rates, and how does it impact what you're doing on a day-to-day basis managing your fund?
It's going to hit you short term. When you have to remember too, it doesn't mean, I was listening to Pat, I was thinking, one of the things an investor has to know is what is your time frame. And my time frame is 3 to 5 years when I invest on. So to me, it's a non-event. It'll just be a chance to buy some things. Now, I don't keep a lot of cash in the fund, but I have a little bit of extra cash personally because I'm going to use, one way or another when they do their first increase, and I don't know when it'll occur.
Right.
I'm going to purchase that day because if it goes up, I'm going to purchase. If it's going to go down, I'm going to purchase. It's just going to be a blip for long-term investors, but it is going to be a blip. I'm pretty sure. So one thing which I do always worry, I always tell people it's like the same thing. Like you're not really worried about stock market corrections. You're worried about recessions. That's really the problem. And for bonds, you're not really worried. We know we have to have some increases because it's abnormal on the short end.
Right.
But you're not really worried about that first adjustment from a long-term perspective. You're worried about inflation coming back.
right.
Because that's where it's a danger. And I know we're not supposed to date it, but I looked at trailing 12 months CPI figures. And it's interesting because you get two signals here. For 12 months, it's actually minus 0.3%. We've actually had deflation for the trailing 12 months. Now, the last 3 months have all been positive.
Right.
And so, at a high clip, like 1.2 for 3 months, which annualizes. 4.8.
Well, and the first quarter, I mean, GDP was negative in the first quarter, so there
yeah.
are some folks out there that are saying, okay, well, the second quarter is going to be over now in 20 days. You know, what happens in that quarter, and, you know, is this going to be a recession? I personally don't believe that.
It's not.
No.
You know,
I'll give you the best indicator for that, because I was talking on the race, but if you go for that, it's the recession is what you worry about for the market. The best, and they're all public. You can Google economic leading indicators and take a look at them. They release them every month. And to give you like an idea, like how they're early, but they work, they have been positive since March of 09, since the beginning of 09, so consistently. Like the last 12 months have all been positive. And the last month was like 0.7%, which is like 8.4 annualized. Like it's really, there's good strength there. And it does work, because the last time it went negative was right after the first quarter of 06. So it was about a year early, because it was really about after the summer of 07 when things broke down. And it was negative all the way down to the bottom, you know, the first quarter, right after it started positive, right after the first quarter of 09.
Right.
I do look at those. I look at the leading indicators probably at least once or twice every quarter, just to see where we are. And I'm telling you, if the market pulls back, we are not recessionary right now.
Yeah.
You usually get 3 to 6 months, you know, heads up by the leading indicators. And 1 month isn't a bad number. You're looking for 2 to 3 in a row, and then you get cautious.
Yeah.
So, you know, it's not coming. If we have a pullback,
yeah, no,
purchase.
use it as, I mean, I am, you know, I mean, we hear it so often. People are so concerned that, you know, I guess I'm getting, you know, older than I used to be, because I'm losing patience with people saying, well, we're due for a correction, we're due for a correction. And I mean, I don't have that crystal ball. Nobody has that crystal ball. I mean, corrections are a part of the process. It's normal. But
well, that's where I thought you were heading. Remember, you were talking about volatility.
Yeah.
That was where you started. Volatility is baked into the system.
Yeah, it's your friend. I mean, you can't, you know, in a riskless world where if you want to invest risklessly and not have to deal with that crazy volatility, there's a way to do it. The problem is you're going to earn 20 basis points.
You got it.
You know, and that's not going to educate your children or
No.
pay for your retirement home or pay for your nursing care if you don't have long-term care insurance. I mean, it's not going to, you know, do the things you need it to do. So you have to accept it's part of the process, and it's okay. It's okay that the market's volatile. Use it to your advantage. I mean,
well, that
you know,
you just said the whole thing. Like I was actually watching on CNBC a interview with a fellow who's a pretty newsletter person, has a pretty good reputation, and he started explaining something which shocked me. That he holds a stock, and it was a stock that I thought was expensive. I'll tell you what, it was CVS. It's not terribly over, but it was fairly priced. And he said, he goes, it's safe money. And then he said a little bit later, there was a stock that he must have talked about on a previous show, and he said, I got out of it because it got too volatile. So right away, he told me volatility to him is a risk.
Yeah.
And volatility is not a risk.
Right.
Volatility, you just said it, use it to your advantage.
Now, let's be clear. I mean, believe me, a correction is, you know, there's a definition of a correction. A correction is, you know,
20%.
Official, you know, you have 10%, then you have 20%.
20%,
And that's, you know, that's acceptable and okay. Now, 2008 was not a correction. I mean, that was something, you know, hopefully once in a lifetime. But that's not what I'm talking about. You know, if we see that company, if there's visible evidence that that's going to occur, you know, you need to call some timeouts and make sure you change things if appropriate.
Because that's the economy breaking down.
But a normal, I mean, you know, when I tell you in the fall, when the market did pull back, it never got to 10%, but it got to 9.9 and change. I went out some more decimal points. And I mean, the nervousness through the telephone I mean, we're in the help me business. We're trying to help people as best we can and quell their fears, you know, but it's part of the process. You know, it's normal.
Right.
But you said the key thing is use volatility.
Sure.
Like I always tell people, and I know people the majority sell. That's why we get volatility when there's any kind of weakness. And then there's like a bad phrase on Wall Street that usually, you know, the first sale is your best sale. Like that's their idea to jump quick, get out of it, and stuff like this. But I use it all the time. I do all my personal purchases on weakness, on corrections. I buy in the fund. Like I'll line up a company which I like, and I never purchase on up days. I purchase on down days. In fact, today, I mean, we're not dating. It was an up day in the market.
Right.
But two of the stocks that had pulled back a bit was a company called Scripps and one Brandywine, which is a income play. And I bought both. You know, it's just because I use that. It's just, you know, it's you know, what does it add to our return in the fund over time? I don't know, but I'm 90% sure it helps. You know, so
how about I have a question from a viewer that I'll ask you both to comment on.
Sure.
I have a question from Amy Wells from local here in Newtown Square, who asks, what stock sector should I stay away from for the long term? I think that's where it gets tricky maybe, but I'll read it again. What stock sector should I stay away from for the long term?
Amy, I would say there is no stock sector that you should stay away from for the long term. I'm talking 20, 30 years.
Right.
Because investing is a long-term proposition. So if you were to have a sector that you wouldn't own for the long term, you would never own it in your life.
Right.
And every sector has its day. I would refine long-term to some specific time period. Mm-hmm. And if you were to say, what sector might I avoid in the next 12 months while we're going through a rising interest rate environment, and that could last 12 months, it could last 5 years, sure. I would say utilities. Utilities are interest rate sensitive. Mm-hmm. So the best way to avoid a punch is not be there. Any
sectors that you're not, you don't like shopping in?
I have my biases, but I'm open-minded to everything. Mm-hmm. There's when you were talking about this, I was thinking about even Buffett at one point when he had bought US Air. I mean, and Buffett, everyone agrees, is one of the all-time great investors.
Sure.
He had joked about with US Air that he has a hotline that he dials now called AA, Airlines Anonymous. Like, don't let me buy another airline stock, and they've done wonderful in the last few years.
Right.
Now, I don't own any. I own one indirectly. Well, it is FedEx, but
sure.
But it's just I think about that. And I think always be open-minded. Right. Anything is an opportunity. So. Pat's right, you have to know your time horizon, but if you're talking long-term, which I think is multiple years, you don't want to ever close your mind to any sector.
Exactly.
So.
Well, Amy, I hope that was helpful. And for the viewers out there that would like to send us questions, we'd love to hear from you. And here's how you can send us your questions.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Thank you again, Amy. And if you have questions, please send them to us, and hopefully we'll give you a good answer.
Pat, let me ask you a question. I'm
Sure.
sure you're noticing the same thing I'm noticing, and that is we're seeing a pickup in the international stock market.
Right.
You're seeing this? Can you give me some reasons why you think it's happening?
Yeah, I not only am I seeing it, and hopefully the message is we're doing something about it.
Mm-hmm.
Because, as I said, what we talked about earlier is the domestic U.S. stock market that has more than doubled, let's say, from the Lehman catastrophe. Well, the international markets, I mean, the MSCI World Index, take out the United States, is almost exactly the same place it was at in 2008. Mm-hmm. It hasn't moved. They certainly haven't had the move that we have. And that's starting to change. So I think it's a time that investors really need to talk to their advisors and make sure they know what portion of their portfolio that is in stocks and appropriately in stocks is in the U.S. market versus international. And I'm advising my clients to take that international portion to the upper end of their comfort level, mm-hmm. because it's much and it's measurably cheaper than our market. I'm still comfortable with our market, but I'm really excited about the international markets. And the why is quite simple. A lot of our market has been driven by the trillions of dollars. We all read about it, somewhat controversial for many, but the quantitative easing, QE, and then QE2, and then QE3, and then QE3.5 here in the U.S., which we did, and on a month-by-month basis, plowed money into the system, which rose asset values.
Right.
Well, internationally, they never did that until 2 months ago. The ECB 2 months ago finally turned the spigot on. Mm-hmm. And they are committed to quantitative easing at least through September of 2016. So not that that's going to have the identical impact of what happened here, but I just know the market's very, very cheap there, measured by PE and measured by yield. The yield's almost twice the yield of our market. I'll give you a fun fact. In Europe, 70% of the companies in Europe, their dividend yield is higher than what they're paying bondholders for a 5-year bond.
Wow.
That's crazy, staggeringly not normal.
And it has to correct.
It has to change. Now, how's it going to change? The only way, there's two ways that it can change. They can cut their dividends. Well, I can tell you that's not going to happen because they already did that. That's already in the rearview mirror. The only way it can change is if the stock prices go up, which will force the dividend yields down, not by cutting the dividends.
And that's what's happening. Again, this show is taped, so talk to your own professional. But at this point in time, the S&P is only up about 2%.
Yep.
And the European index is up close to 15.
Yeah. It's going to be volatile, but I'm really very excited about what's happening internationally and what I think is going to continue to happen for the next several years. Do you invest internationally at all?
I had one, and I sold it. So.
I had one and I sold it. I know you're a domestic guy. Well, let's shift gears back to the U.S. What I think our viewers always like to hear, some of your companies that you're excited about and why you're excited about them. So why don't you talk to us about some of your companies?
Well, I actually started to tell you that. I printed up our list of holdings, and I was going to go through and pick 3 or 4 that I like. And I'm telling you, I was trying to be objective. They all appeal to me.
Okay.
Why?
Tell us what.
There's just good valuation. Like the one thing that's tough, the market was dirt cheap in 2009, but fear was rampant. Everyone thought the worst was going to happen and so forth.
Right.
This year's an off year, and there's a lot of things that played into it. The dollar strength is probably one of the most important things.
Sure.
A couple of energy hurting some certain sectors, like probably that's one of the things that probably led to that negative GDP in the first quarter. But the thing that's really, I think, is very, very powerful and stuff like this, and even with the rates coming up and stuff like this, is that we're over the hump. We're in normal periods. We're seeing tremendous buybacks. We see tremendous inside buying. Now, they should have been doing it a couple years ago,
right.
But it is what it is. So, we're setting up, but it goes back. You don't have to be, very picky. I go through 3 or 4 of our stocks. Not only are they attractive, well, I'll take one, Scripps. And it's not at hype. We've owned it for a few years. I've actually been adding to it recently. The company is selling at about 7 times EBITDA, 7.5. One of the things which I love that they had not been doing all along is buying back stock. One of the things I look at is what I call the owner's yield. And that's a combination. I just look at net buyback, so they'll issue some stock through options or employee programs. But what they bought back, net of anything they issued, plus the dividend divided by the year-end price, that stock was giving about a 13% yield. So the way I look at it, I think here's a great company, unlevered, symbol is SNI. They provide content, so I don't have to worry about who's going to win between Netflix or Dish or cable and so forth. Everybody wants content. Unlevered, selling at 7.5 when probably the sector's 10.5, 11 times EBITDA, doing the right things, buying back stock. Plus, it's also a potential takeover. It went through an attempt about a year and a half ago, fell through. The stock was up in 84, and now it's in the high 60s. So it's everything I like. And what's great about my fund is I'm a concentrated. I can buy as much as that up to a certain percent that probably most people are comfortable with, just like I will with your own portfolio. But no, and there's other companies, Cabela's. It's got great.
I know you've owned that for a while.
Oh yeah, it's funny. I had a shareholder call and complain because the last year and a half it's done terrible. It's literally up tenfold from the market bottom. You could have bought all you wanted that stock 5 to 6. It's in the 50s now. Another company that's unlevered, growing, probably going to grow 14-15% a year. You could buy it at 7.5 times EBITDA. They're just. I don't care what anyone says. I don't know what the market will do, but I'm 90% sure we'll make money and stuff like that. So.
Well, Pat, I'm not going to ask you to talk about individual stocks because I know you and I can't.
Right.
But how about some sectors? Can you really, let's say 2 ways. Are there any sectors that you're avoiding right now or underweighting, and are there any other sectors that you think look attractive based on maybe the interest rate environment and other things that are occurring?
Exactly. I have been avoiding both utilities and telecommunications. Mm-hmm. And I've been putting my emphasis on technology and in healthcare because I'm seeing some terrific growth rates in those areas.
Yeah. Yeah, healthcare is one that, I mean, it's, what's happening in healthcare, and when you say healthcare, it's so darn big.
Oh,
I
yes.
mean, you have the big pharmaceutical companies, and then you have the biotechs, then you have these companies in the middle that are kind of both. They're pharmaceuticals, but they're also, you got a pipeline that's terrific, and I mean, there's really some exciting things happening in healthcare.
And how about you? What areas are you looking at?
I like to be diversified, very diversified and broad based, but I actually am a big fan of what's happening in technology. The whole revolution or evolution of the automobile literally becoming, a really smart computer on wheels, and all the things that are happening with that. I mean, there's some chip companies that are just growing their earnings and revenues very predictably at 30-40% a year, and all the technology that's occurring with mobile payments, whether you talk about Apple Pay or the other competitors of Apple Pay. I mean, that's that all that stuff needs things to make it work. And if you have a good research analyst or a fund manager that can invest within technology, there's always going to be ideas in technology that I think that can grow a lot faster than a normal big consumer company. So I think if you have a good stock picker in that area, I think you're giving yourself a head start. Mm-hmm. How about one more name you want to talk about? I know you're dying to talk about companies.
Actually, it's a local one, Brandywine Realty Trust.
Okay.
And it ties into what Pat was saying. It really has been sold off this year, mostly because I guess it had done well. Most REITs had done well because people were looking for income. But the funny thing is the income hasn't changed. The prices come down, so you get a better yield. It's in the mid-4s. It's probably selling at least 20% below what it would liquidate its properties for. Mm-hmm. And one of the things it ties in a theme. I always tell people when you have free money, there's 5 things you can do in our system. It's basically cash, stocks, bonds, real estate, and private business. Throw private business out because you always do that when you have a good idea. Right. Cash doesn't pay anything. Bonds have too much risk. It's stocks and real estate. And if you look at Brandywine, which is a REIT,
it's both.
Gets it right in there. Yeah. It's got good valuation. Right. Oh, and in that same theme, the home builders. If you really want to get it's not. There's no REIT that really gives you direct to home ownership, but it's going to get better and better. And those stocks are still very cheap. We own 2 in our fund, Horton and Ryland, and they're both wonderful. So.
Okay. Well, terrific. Well, I mean, I know we could sit here and talk for hours, but we have a time date, and we're up against the deadline. So it was great working with both of you. And for the viewers out there, we thank you and appreciate your time. You can always view us. You can view us. Just go into Google and put in Money Matters TV, and you'll see plenty of ways that you can view us. We're on Stitcher Radio, but moneymatterstv.com. And as always, your money matters.